Hey everyone, welcome back to the channel. Today we're diving deep into a massive under-the-radar shift happening in crypto right now. Big money is quietly rewriting the rules, and it could define the next financial cycle. A Nasdaq-listed firm just built a staggering $530 million Solana war chest. At the same time, Ethereum-focused corporate treasuries are reporting record-breaking gains. So, what does this all mean for the future of SOL, ETH, and your portfolio? Stick with me, because by the end of this video, you'll understand why corporate treasuries might just be the biggest, most explosive play of 2025. Let's kick things off with Solana. A company, formerly known as Helios Medical Technologies, has made a monumental pivot. They now hold over 2.2 million SOL tokens, plus $15 million in cash. At current prices, that puts their reserve value at nearly $530 million. This move instantly places them among the top corporate treasuries accumulating crypto assets, right alongside giants like MicroStrategy. But they're not alone in this game. While Solana is making headlines, Ethereum treasuries are quietly stealing the show. Take SharpLink, for instance. Their holdings in ETH are now approaching a mind-boggling $1 billion in unrealized gains. Then there's BitMine, which recently added over 179,000 ETH to its stash, pushing its total balance to more than 2.8 million ETH. And it's not just direct purchases. We're seeing institutional flows for spot Ethereum ETFs rising sharply, signaling a broad-based institutional embrace. So what we're witnessing is a powerful two-front advance: aggressive Solana accumulation on one side and massive Ethereum treasury expansion on the other. This sets up a fascinating showdown. Will SOL or ETH treasuries lead the next major breakout? We'll compare them head-to-head in just a moment. So, what's really driving this trend? Why are publicly traded companies suddenly stacking crypto like it's digital gold? Well, there are 4 key reasons. First, and most importantly, is yield and staking. Unlike idle cash sitting in a bank account losing value to inflation, assets like ETH and SOL can be staked to generate passive income. This makes them incredibly attractive for corporate treasuries looking to make their assets work for them. Second, it's a classic inflation hedge and diversification play. Crypto offers a powerful alternative to traditional fiat systems, providing a hedge against currency devaluation and a way to diversify a company's balance sheet. Third, it's about signaling and confidence. When a public company invests hundreds of millions of dollars into a cryptocurrency, it sends a powerful message to the market. It's a massive vote of confidence in the long-term viability and potential of that asset. This can create a positive feedback loop, attracting even more investment. And finally, there's the growing regulatory and infrastructure readiness. With clearer regulatory frameworks emerging and institutional-grade custody solutions becoming mainstream, large companies now feel much safer holding these digital assets. The operational risk is decreasing, making the leap into crypto far less daunting than it was just a few years ago. Now for the main event: Ethereum versus Solana. Which one is the better treasury asset? Let's break it down. Ethereum is the established king. It's more mature, has a much larger and more battle-tested ecosystem, and enjoys broader demand across DeFi, NFTs, and Layer 2 solutions. Its ultra-sound money narrative, thanks to the token burn mechanism, is incredibly compelling for long-term holders. For a conservative corporate treasurer, ETH represents a safer, more proven choice. But then you have Solana, the high-speed challenger. SOL boasts incredibly fast transaction speeds and significantly lower fees, making it highly efficient for certain applications. This performance has attracted a wave of new projects and, as we're now seeing, increasing corporate demand. A company looking for both growth potential and operational efficiency might find Solana's profile very appealing. The real question isn't just about which technology is better, but which one will ultimately deliver higher returns for the companies holding it, and for the investors betting on this trend. Of course, a move this massive doesn't come without risks. It's crucial we look at the potential downsides. The most obvious risk is price volatility. A sudden sharp crash in the price of ETH or SOL could completely wreck a company's treasury strategy and lead to massive write-downs on their balance sheet. Imagine the shareholder reaction to that. Then there's regulatory risk. While clarity is improving, governments could still clamp down on corporate crypto holdings, forcing companies to sell or creating an uncertain operating environment. Another major risk is selling pressure. What happens if these large corporate holders decide to cash out their gains? A few large sales could trigger a cascade of selling, causing the price to slump dramatically. And finally, we can't ignore technical and protocol risk. Even established networks aren't immune to bugs, network failures, or sophisticated governance attacks. A major failure on either Ethereum or Solana would severely damage institutional confidence, and the critics are already making their voices heard. Prominent crypto commentator Samson Moe recently warned that Korean retail investors are a major force propping up ETH treasuries, and he suggested this reliance on retail fervor might not end well. Others argue that the trend is simply becoming too crowded. If too many treasuries are all chasing the same yield-bearing assets, it could create a bubble that's destined to pop. These are valid concerns that any serious investor needs to consider. So, if you want to track this trend like a pro, what signals should you be watching? First, keep a close eye on new announcements. Which company is the next to announce a Solana or Ethereum treasury strategy? For example, Forward Industries just launched its own Solana validator and staked millions of SOL. These announcements are major market-moving events. Second, watch ETF and institutional inflows. Big capital flowing into spot ETH, and potentially in the future, SOL-based financial products is a key indicator of institutional appetite. Third, dive into the on-chain data. Look for whale accumulation, monitor staking metrics to see how much supply is being locked up, and track the flow of tokens on and off exchanges. This data gives you a real-time view of what the big players are doing. And finally, don't forget the macro picture. Keep an eye on interest rates, global regulatory news, and anything else that could shift the market's appetite for risk. And specifically for traders, pay attention to key price resistance levels. A decisive break above a major resistance level for SOL or ETH could be that all aboard, signaled that the next leg up has begun. Let's game out a few possible scenarios for how this trend could play out. First, the bullish breakout scenario. Corporate treasuries continue to accumulate SOL and ETH, creating a supply shock where demand consistently outpaces available supply. In this scenario, we could see ETH push towards the $7,000 to $9,000 range, and SOL could rally to $500 or even higher. This is the dream scenario for holders. Second, the stagnation scenario. The market chops sideways, accumulation slows down, and treasuries hold their positions but don't add aggressively. Prices remain range-bound, and the explosive breakout we're all hoping for fails to materialize. It wouldn't be a disaster, but it would be disappointing. Finally, there's the correction or blow-off top scenario. The hype gets out of control, the trade becomes too crowded, and then one or two major companies decide to take profits. This triggers a panic, and the market reverses hard, wiping out a significant portion of the recent gains. So how should you position yourself as a trader or investor? The key is to stay nimble. Don't overcommit to one side too early. If you believe in the long-term thesis, consider using dollar-cost averaging to build a position over time. This smooths out your entry price and reduces the risk of buying the top. Pay close attention to treasury announcements, as these surprises can create incredible volatility and trading opportunities. And always manage your risk. Use stop losses and smart position sizing to protect your downside. A prudent approach might be to allocate a portion of your portfolio to this treasury narrative, perhaps with some careful leverage on altcoins, while keeping the core of your capital in safer, more established assets. Make no mistake, the rise of corporate crypto treasuries isn't just a fleeting fad. It represents a fundamental and powerful shift in how capital is being allocated on a global scale. It's a validation of the entire crypto space. So, I have to ask you, which side do you think will come out on top? The established giant, Ethereum, or the high-speed challenger, Solana? Let me know your call in the comments below. I'll pin the most insightful one. If you got value from this deep dive and want more analysis like this, do me a huge favor and smash that like button, subscribe to the channel, and be sure to ring that notification bell. That way, you'll never miss our next market update. Thanks for watching, and I'll see you in the next one.